Greetings and welcome. For the purposes of this video, I wanted to take a really quick look at Cornerstone's CRF and CLM funds. These are frequently mentioned by Todd at his Unconventional Wealth Ideas YouTube channel. He can be found on YouTube at Mr. Todd Aiken. This is honestly where I first learned about these funds, and he I wouldn't say he I guess I would say he promotes them pretty heavily, basically as no pun intended here, cornerstones of his investment strategy. So obviously I was curious, wanted to take a quick look and understand how these funds work. So the two funds, CRF is a Cornerstone Total Return Fund. CLM is a Cornerstone Strategic Value Fund. These are closed-end funds, not ETFs. The main difference for the uninitiated is think of with ETFs, as people come into and out of the fund itself has to create additional shares or liquidate assets or expend cash to pay off. So the number of shares outstanding can float based on the investors in an ETF fund. Versus a closed-end fund, which will have a limited number of shares outstanding, and the value of those then can fluctuate based on supply and demand. They can trade in excess of the net asset value, or they can trade below the net asset value. Closed-end funds are, for regulatory purposes, are able to invest in a broader range of things than an ETF generally is. So that opens up options for them to be involved in different things. CRF and CLM kind of are promoted as growth or value funds. In my opinion, these really are income funds, though. A key benefit of both of these funds, and this is something that Todd talks about a lot on his channel, is that they drip at the NAV. So if you are with a broker that supports the special drip program with Cornerstone, then your distributions, which are monthly, will reinvest at the net asset value. This is a fantastic feature of these funds because, at least right now, and I think historically as I look back, they trade at a premium to the net asset value. Also, most years, not every year, but most years, they do offer to existing holders what they call a special rights offering. And we'll talk about this here in just a second as to how special it is and what seems to be the consensus on how to play this. So some notes about these. The distribution plan for both of these funds resets every October. So it is a fixed monthly distribution, and that distribution is determined basically in the previous year. So it's consistent. It does not fluctuate. The Dividend Reinvestment Plan, the DRIP, is available through some brokers like E-Trade and last I knew Fidelity as well. This is not presently available to Robinhood accounts. And in fact, these funds are not available to trade at Robinhood. So you will need to be at a different broker that offers closed-end funds and also has the integration and things required for the special drip on these. I mentioned the rights offering. This goes out to existing shareholders. And historically, the way this looks like this is done is they offer the right to buy one share at the net asset value for every 3 shares held, with no fractioning. The apparent best way to play the rights offering is not to participate. I didn't do a thorough analysis trying to figure out exactly what the timing and everything would be, but essentially, it appears to be involving selling the shares when the rights offering is announced or at the beginning of the rights offering period, and then buying them back after. Because the effect of this is you have a bunch more shares being generated, and some people are going to liquidate those shares. These shares are being purchased at the net asset value and so forth. So it essentially dilutes the existing investment down. And I think from what I could looking at the charts going back, it does look like the funds tend to lose price value during these periods. Again, I didn't do an exhaustive look at this. I just wanted to take a really quick look and summarize these. I will put a couple of links in the comments for some videos where I think people have done maybe a little deeper dive into these. The difference between the two funds, CLM seems to have more international exposure. They are heavily diversified, though. They do track with the indexes pretty well. But again, CLM does seem to have more exposure internationally. Because the distributions are fixed in advance and they are not pegged to current fund earnings, I suspect that they would underperform via NAV erosion in a down market. So they've got distributions that are fixed. The fund may not be growing in value or earning money, but they're going to make those distributions and then reset it later at the end of the year. As a result of this combination of things, in my opinion, this isn't a buy it and forget it fund if you want to maximize results. That doesn't mean that you couldn't buy it, subscribe to the drip, and probably end up okay over the long haul. But I think if you really want to maximize the value and the potential in these funds, it's not going to be a buy it and forget it. You're going to have to pay attention to these investments. So just a quick summary as things stand right now. This is as of the end of last week. Current price for both of them is up in the $8 range. CRF is at $8.83, CLM at $8.49. You can see they are trading at a premium to NAV. CRF at a 26% premium to the NAV. CLM not as much, 15.7%. And you can see here the monthly dividend amounts, very, very, very similar. One a little bit closer to 11 cents with CLM, CRF a little closer to 10 cents per month per share. And you can see what that works out to annually there. So current yield based on the current price, you're looking at 14% and 15%. So not bad. As of this last October, they announced the 2025 monthly dividend rates. You can see they both went up, and by a reasonable amount. CRF a little over 11.5 cents per month. CLM just over 12 cents. And so at the current share prices, those yields are hefty. Here we see the actual announcement on November 1st of the resetting of the dividend payouts. And they do this based on the NAV at the end of October each year. There you see the updated per share amounts that we were just talking about. You're looking at almost 16% on CRF and over 17% on CLM. These funds have done well this year. If we go and look at both of these funds and we look at their performance from the past year, you can see CRF is up 24%. If we take a look at CLM, up 18.5%. So they have performed well this year while continuing to distribute income. However, if we take a look at the 5-year chart, you can see we have negative return here. Now, this doesn't account for dividend reinvestment. It does not account for timing things around the rights offerings. So do understand that over time, it does appear that these funds, and actually let's go over and look at the other one real quick, pull that down as well, the same situation. So again, this is why I don't believe these are funds you just buy, uh, click on the drip, and then just let ride, because I think there's a more efficient way to do this. Again, that's my opinion, and that's without having uh, vast experience owning and managing these funds in an account. If we go and take a look at Morningstar, we can see that CRF and CLM both are currently rated 4 stars. They have at times been listed as 5-star funds. Currently, Morningstar has them as 4-star funds, so not bad. So if we look here at the drip, these are live examples from an E-Trade account where the shares that were purchased via the automatic drip were purchased at much lower than the trading price. These dripped right at the NAV, and you can see as a result the total gain, since they are trading at a premium, the total gain is substantial on these additional shares that were acquired. So, in summary, again, just taking a very quick cursory look at these, I do think they are interesting funds. I do think they could be worth being a part of someone's portfolio if, again, it's going to be actively managed, and someone's going to be paying attention to when those rights offerings are happening, and things like that. So I'm probably going to keep a little bit of this. One advantage, at least at E-Trade, is that these have a margin maintenance requirement of 30%. Um, so for a higher yielding fund like these, and again, we're not talking like ultra high yield like the yield max funds and things like that, but for this type of fund, for the maintenance to be down around 30%, not bad. One last thing I think is worth mentioning is that these funds may invest, per their prospectus, in other funds. Those funds that they invest in may have their own management fees. So some of the investments in this fund, you could be doubled up on management fees between cornerstones and then other things they've invested in. So if that's something that bugs you, these may not be for you. Thanks for watching. Please like and subscribe to the channel if so inclined, and I hope you're having a fantastic day. Thanks a bunch.